Indigenous history and culture, and committed to moving forward in the spirit of reconciliation and respect with all First Nation, Métis, and Inuit people. So today we have Lucas Perlman, who is the principal at StandUP Ventures. Lucas began working at the firm back in 2020, and his role mainly includes sourcing and evaluating prospective investments, providing support to portfolio companies post-investment, and managing the fund's finance and reporting obligations. Lucas spent the previous 5 years before joining StandUP to supporting entrepreneurs and startups. He was at the Mars Discovery District, and he led the business development and investor relations efforts on behalf of their B2B SaaS portfolio. Prior to this, Lucas spent 2 years managing ANZA, an accelerator for entrepreneurs in the Tanzania, demonstrating. That's cool. Tanzania. You were in Tanzania? Sorry, I'm like, that is really awesome. You have to totally expand on that. That's really cool. And he was demonstrating his commitment to entrepreneurship on a global scale. Lucas brings a strong financial background to his work, and he's earned a Bachelor of Business Administration from Laurier University and obtained his CPA designation as well. So today, Lucas is going to be walking you guys through VC 101, as well as diving into fund construction. This will be from about 12 to 1 o'clock. And we're also going to be having a Q&A at the end as well. But it's super casual. So even if you have questions throughout, feel free to jump in or toss your questions in the chat. But with that, thank you so much, Lucas, for taking the time to be here with us today. And I will hand it over to you.
Thanks, Megan. Great to meet everyone today. And thanks for the intro. I'm going to share my screen shortly, but what would help is if you could put the firm you're with in your Zoom name, so I can just see and gut check on where you're coming from in the kind of capital stack, so to speak. I'm going to share my screen. Okay. Can everyone see the slides?
Yeah, it's perfect.
Sweet. Okay, awesome. Well, I'm not going to spend too much time introducing myself, but as Megan said, I'm with StandUP Ventures. We are a seed stage venture fund based in Toronto with folks in Montreal and Vancouver as well. We invest in predominantly B2B software businesses at the seed and pre-seed stage, a little bit of Series A. But we invest in companies that are led or co-led by women. We're not an impact fund. We are a venture capital fund seeking top quartile returns, and investing in women is just an excellent investment strategy, in our opinion, our chosen way of going about doing that. We're investing out of our second fund, which is a $35 million pool of capital. We have 27 portfolio companies. Our first check is kind of in the $500,000 to $1.5 million arena. I would say we're leading rounds more often than not, but are happy playing whatever role makes the most sense for the syndicate. And as I said, mostly B2B software business models. So that could be SaaS, that could be marketplaces, that could look like a digital health with an insurance association to it. We're flexible in that arena. I'm a principal here, as Megan said, kind of business and finance background by training, went to Laurier, did the whole accounting thing after graduating. Met lots of wonderful people doing the accounting thing, but certainly wasn't for me. So I left soon after getting my designation. And as Megan said, I lived in Tanzania for a few years, and I worked with an organization called ANZA there, which still is, and I'm still quite involved, an accelerator and small investment fund for Tanzanian entrepreneurs building, I would say, innovative, but not necessarily all tech businesses. A lot of bread and butter kind of agri-processing, things like that. That's how I kind of got into the world of entrepreneurship and certainly funding entrepreneurs. Moved back to Toronto ran out of money and needed to come home and get some stuff going, and worked at Mars for almost 5 years, where I worked with the portfolio of B2B SaaS companies that Mars supported through their what's called venture services, which is basically an accelerator, working with investors across the US and Canada, trying to get them connected to portfolio companies at Mars to raise capital, as well as working a lot with corporate partners, be they American, Canadian, or otherwise, and trying to facilitate basically getting corporate customers for the startup portfolio as well. I met Michelle McBain through working at Mars. Michelle leads StandUP, and I joined the firm initially in a part-time capacity in 2020 and went full-time soon after. And here we are today. So I know Megan said 15 minutes for questions at the end. Don't worry about that. Interrupt me at any point. Doesn't matter. All good. Some familiar group names on the call here. So Northleaf is one of an investor in StandUP Ventures. And then Virtu, Lisa is actually a personal investor in StandUP Ventures and a very good close friend of Michelle's. And then Birch Hill and Fort McKay or McKay Landing, looking forward to learning more about you. So I was going to cover two things in this presentation. The first is introduction to VC, and the second is fund construction. I'll be transparent. I think the second part is a lot more fun. The first part, I just want to get like a bit of a show of hands and come off mute and share things. I'll just do a quick rundown of like how the funds are designed from an entity perspective, the metrics that funds report on, who the kind of LP landscape is, safes and convertible notes versus priced rounds. Is this stuff you know already and you've had lots of exposure to, or would you want to go over it? Maybe someone put their hand up if they would like to go over it, or yeah. Just give me some feedback here would be great. You want to go over it? Okay, thanks, Lynn.
Got another thumbs up. Yeah.
Okay, I'll try and do it relatively efficiently. And if I'm going too fast and you have a question, don't hesitate to interrupt me. There's probably different levels of exposure on the call. So don't hesitate if you have what may be considered a basic question. That's great. Please ask it. I see something in chat here. Yeah, okay. Thanks, Megan. Okay, so 4 areas, just VC fund structure, the LP landscape in Canada, the metrics and benchmark, and just the instruments that we invest in. So a venture capital fund is a closed entity, typically a 10-year entity, where you make investments in the first 3 years or 3 or 4 years of that 10-year cycle. And then, so you basically build your portfolio in those first 3 years. And then over the remaining kind of 6 or 7 years, you manage out that portfolio, you exit those positions and return capital to your investors. The way this works is this blue piece is that venture fund. That venture fund has investors, which are called limited partners. And I'll talk about who those limited partners mostly are in Canada in the next slide. And then the fund is managed by the venture capital firm. Typically, the partners at that venture capital firm will also put some of their own money into the venture fund. And then this venture fund will make investments in portfolio companies. Now, over time, venture firms will add net new venture funds. So for StandUP, we are in our second fund, which means we have 2 blue squares for us. The first one, a $21.5 million square, and the second one, a $35 million square. For us, the first fund has 16 investments in it, and the second one, we hope will have between 20 and 25 investments in it. We're actively deploying it. Any questions on this? Okay. Jump back in it later if something doesn't make sense. But concept here is venture funds are closed entities. They each have their own unique set of investors, but they're managed by a firm who can have multiple funds under its purview. Okay, this is what the LP landscape broadly looks like uh, in the Canadian market, and there's people's names here because I think they're familiar to many of you in the program here. Sylvia, I see you smiling. The first group is the funds of funds group. So there's Northleaf, Terralis, HarborVest, Kensington, and then some of the more Crown associated ones. So BDC, Export Development Canada, AEC, which is Alberta based. And They are asset managers allocating capital across a variety of asset classes. Venture capital falls into the alternatives bucket, and most of these groups have an allocation to various venture capital funds in Canada. An important distinction to call out for Canada versus the US is in the US, pensions and university endowments play a big role in the LP landscape. So universities like Stanford and Harvard and MIT, they're very prolific investors in venture funds, and some of the biggest backers of like all of the name brand Silicon Valley venture funds that you might be familiar with. That's not really a thing in Canada. Similarly, pensions. Pensions uh, are, again, pretty common LPs in the US and less so in Canada. The CDPQ in Quebec is a bit of an exception. OMERS has their own venture fund. They're like in-house venture fund, for lack of a better word, in Canada. And then some are investing in the fund of funds. Sylvia, you probably know more about that than I do, candidly. But some are investing in the fund of funds, so it does trickle down. But for the most part, the teacher's pension plan and folks aren't LPs in Canadian venture funds. I see a chat question. Uh, um, Snip away, Sylvia.
Thank you.
And Megan can send this around, and Megan and Sarah.
Totally. Yeah, we could definitely send out the slides afterwards.
Um, I've updated a little bit since last year, Megan. I'll send you the updated version. Okay, so corporations is the other bucket. So think banks, RBC, CIBC, Deloitte, for example, is LP in StandUP. They all are doing this for different reasons. Some it's just they want to put their balance sheet to work and it's an asset class of interest. Others, it's for distribution. They're trying to get access to a certain type of customer. Others, it's for strategic technology interests. They want to partner with venture firms who have a thesis in a certain technology area, and they want to get exposure to what's happening there, and whether it's for future M&A or all kinds of things. Every group has a bit of a different take. And then the third bucket is just individuals. So this could be family offices, wealthy people who have set up a family office to manage their capital, high net worths, former founders or employees of successfully exited companies. So like a lot of Shopify alumni are LPs in Canadian venture funds, and so on and so forth. For kind of big picture metrics, there are others and there are wrinkles on these, but I'll just give like a quick high level summary of these. So the first is IRR, or internal rate of return. And this is just basically annualizing your rate of return by looking at how much cash has gone out over the last number of years or however long the fund's been in existence for, versus what's the current fair market value of the investments in that fund. And you run this formula and it'll spit out a number. And this lets you compare it to like what the S&P 500's IRR would have been over the same period or something like that. This reflects this is a indication of performance of a venture fund, but is by no means a metric that you can look at in isolation, because we're investing in private companies. Their valuation doesn't fluctuate in the same way that a public stock would. And so you could both have a company in your portfolio that's marked too high. It raised money at a really high valuation and has not performed well. And so those valuations aren't as quick to correct as public company stock would be. And then vice versa. You could have a company that raised at a valuation and executed extremely well, and it hasn't been marked up to reflect that necessarily as well. Um, the second metric is multiple on invested capital. And this is basically the current value of all your investments divided by how much you invested in them. Pretty basic one. The third one is total value of paid in capital. So this is a bit of a nuance on MOIC, but it's basically the value of your unrealized investments plus any cash you've returned to your LPs from exited investments, positions you've sold, divided by all of the capital paid in to date. And so what I failed to mention in the first slide, and I should have, is LPs are paying fees to the venture fund to run their business. So typically 2% a year, lets them have employees, rent office space, travel, buy computers, all that good stuff. This metric captures that cash outlay from the LP in the denominator as well. So the denominators are different in those two metrics. And the last one here is the most important one when all is said and done is distributions to paid in capital, or DPI. It's basically how much cash did you return to your investors, like when all is said and done. So if you have a $10 million fund and you returned $20 million to your LPs, you would have a 2x DPI. And so this is something that you'd expect to be low in the early years of a fund and then increase as the fund gets older, because the companies need time to mature and exit. If you're a seed stage fund, you'd expect to have low DPI in the first couple of years of that experience. Any questions on this? Does this make sense? Am I going too fast? You know all this? And come off mute, don't be shy. Okay, last piece here before we get into fund construction is just the typical instruments. So there's two buckets. One is like a priced round. The second is convertible instruments that happen before price rounds. So a price round is like the most traditional thing. That's what kind of most the exposure you probably would have had to venture. Investors are coming in and they're setting the value of the company. The company is issuing shares, and the investor is purchasing shares at a valuation and price that's negotiated by those two parties. There are two types of shares that can be purchased. One is preferred shares. One is common shares. Preferred shares, common shares are just like basic shares you can buy that give you a certain amount of ownership in the company. Preferred shares provide that as well, but with some sweeteners and additional rights. And 99% of VC deals that are price rounds, VCs are buying preferred shares. We would candidly not invest in a company if they're issuing common shares. And so there's multiple rights that typically come with preferred shares. The one I'll call out as kind of being maybe the most pertinent or like for use of description here is a liquidation preference. And what that's basically saying is it's downside protection for the VC, for the investors. They get their capital returned to them before any other shareholders can participate in access to capital. So let's say we invested $1 million into a company, and that company sold for, and we got 10% of the business, and that company sold for $1.5 million. So you might think we would get $150,000 back, which would be not great. We would have lost a bunch of money to reflect our 10% ownership. What actually happens is we would get our $1 million back and nobody would get anything else. That's the most extreme kind of variation of this. If the company sold for $50 million, this wouldn't happen. We would just take our 10% of that exit, $5 million, and be on our merry way. Does that make sense? There's other rights as well. Approval rights, rights of first refusal, all kinds of things as well that come with it. But that's one I'll point to. Okay. Non-price round, so the convertible instrument. So there's typically two types. One is called a SAFE, a simple agreement for future equity, or a convertible note, which is a convertible debt instrument. And the idea of these is They're typically used for either really early stage deals or like bridge situations when companies need to bring in more capital from their existing investors before going out to the market to get new investors. Um, and the idea is that you're like kicking the can down the road on pricing and valuing the business. And so the way these work is the instrument will have a valuation cap and a discount. And the idea is that when a future priced round occurs, it will convert at the lower of the valuation cap or the discount. So for example, let's say we invested $1 million in a safe that had a $10 million valuation cap and a 20% discount. Say a year later, the company did really well and they raised money at a $20 million valuation. Uh, when they go to issue us shares for our safe investment, they would use that $10 million valuation to determine how many shares we get in the business. So basically, a million divided by or 10 divided by a million, get 10% of the thing at that point in time. The math is more complicated than that. But um, if the company maybe didn't do as well, but they're able to raise a price round at an $8 million valuation, our safe shares will be issued based on a 20% discount to that $8 million valuation. So that's the idea here. Um, the only other distinction I'll call out is that a convertible note is debt. So there's often interest associated with it, and it has the features of debt. There's recourse, you sit above everybody else in kind of the liquidation waterfall. A safe does not have any of those things. So for a bunch that reason and more, safes like aren't a lot of VC's favorite things. But they become incredibly common at the very early stage, and they became extremely popular during like the bull market of like the COVID run a few years ago. They're really fast, really easy. The legal fees are cheap. So there's a bunch of reasons why they make sense, but there are some like they can be complex, and a lot of the times founders don't actually realize how much of their business they've given up when they just stack a bunch of safes together. So there's reasons to be cautious. Any questions on this stuff?
I feel
Okay.
like, Lucas, before you dive into the fund construction, one of the questions that we get quite often that could, I feel like, fall in VC 101-ish is just like the current landscape of the industry right now. Like, I feel like that's always a common question of like, what is the industry like right now? Where do you see it going over the next year? If you could talk a little bit about that.
Okay. I'll try not to talk for too long. Um, so I think you'll get a different answer depending on the stage of investing that like whomever you're speaking to. Like I can only speak from the vantage point of like a seed stage investor and then some exposure to our portfolio companies that are raising later rounds. A Series B investor will tell you something different. Um, I think like in terms of like some themes in the landscape, um, it's certainly like still quite hard to raise an early stage round in Canada and in the US too. Um, there's a lot of frothiness and hype around AI deals that like I personally am cautious about, and I think a bunch of mistakes that are being repeated that were made in 2021. We're not as exposed to that in our funnel, but it's certainly happening. And so uh, that it's hard to raise money right now if you're an early stage a company. Like I don't think there should be anyone sugarcoating that. But I think there are some like very good reasons for that. So one is the entire market, I think, either has or certainly should have re-underwritten what the terminal value of a tech company is when it exits and all is said and done. Um, and what that means is, I think there was a period of time that certainly peaked during COVID where the um, view of what could become a venture scale outcome was made too broad. And a lot of companies that got funding like probably should not have. And if you really looked at the fundamentals of what they were doing, the markets they were building in, the interest in like pedigree of the founders, like it's probably going to be hard for a lot of those things to generate the size of outcomes that VCs need to make money. And the real I'll get into this in fund construction, like they need to be big companies. It's pretty hard to generate meaningful returns with small exits. Like we're talking like you need to be like $1 billion or high hundreds of millions of dollars to move the needle for a fund, or at least for like a true venture fund. And I think that's contributed to it being hard to raise capital. As VCs are going through that process of reorienting themselves around like, is this a company that could go public one day? Is this a company that, just could generate $100 million of ARR, $50 million of ARR? And I think VCs are asking harder questions about that. The second piece is, we're in this kind of fog period of like, what will the future of technology look like in 2 years, 5 years, 10 years? Like you have everyone on one side of the spectrum being like, SaaS as a business model will cease to exist. And then you have other folks being like, AI is like fake, or it's not going to generate real economic value. Like, probably neither of those things are true. But there's certainly like, we're thinking a lot more about like the disruption risk that faces certain businesses if we just ask the question in 2027 when GPT-7 is out, like, is what this business does going to be commoditized? And if the answer is like maybe yeah, then we should be more cautious. So I think that's contributing to it being hard to raise. And then the public markets are still closed. Like no one's IPOing, multiples are low for software companies. That's why I think the terminal values of these businesses are lower than they were over the last 10 years. The multiples are lower, and I think should expect them to stay that way. Um, that was a ramble and that maybe went too meta, but I hope that answered some of the questions, Megan. Happy to elaborate or say more on anything if anyone has any specific questions there. Okay, can I move on to fund construction?
Let's do it.
Okay. Okay, this is like my like nerd favorite thing to talk about in venture. I think this is like um certainly extremely underappreciated by a lot of either people who are new to the industry and frankly a lot of people who've been in the industry for a while too. And I think as it's gotten harder uh, for startups to succeed, this becomes even more important. And a lot of what happens here is like, funds will raise capital, they'll have a fund construction strategy in Excel, they'll use that in their fundraising process, and then they'll like, human nature is such that you can deviate from that and maybe you don't pull that spreadsheet out of your Google Drive too often and see how you're doing against your initial plan. And so I think this is a really important concept to just understand the fundamentals. And then from a practical standpoint of like being in a venture fund and being discerning and disciplined, to constantly be refining this on a quarterly, semi-annual basis with the team. Things change, the world changes, you have to change with it. And then to reflect this in every deal you're looking at and making sure the deal matches your fund construction. And if you do that, it can lead you to pass on really exciting opportunities just because they don't fit your strategy. And that's good. I think that's a healthy dynamic. And so I'm going to cover, I guess, 6 concepts here: ownership targets, uh, kind of check size and follow-on strategy, how many portfolio companies you want in a fund, survival rates of your companies, pacing, and the last piece is recycling, which is a really important concept. Please do not hesitate to interrupt me and ask clarifying questions because I may be going a little bit fast here, and it's always difficult to calibrate like an audience like this, like how much some of you have seen this before, how much some of you haven't. So like feel free to interject, all good. So the first one is like, in my opinion, the most important, which is ownership targets. And this is basically how much of the business do you want to own with your capital? And a common rule of thumb is that every investment that you make, when you make the investment, you should have a plausible thesis that if everything broke right for this company, it could return the whole fund. So, um, uh, and what matters in doing that is how much you own of the business when the company exits and is sold. So let's say you own 10% of the business when you first invest at seed. The company's very successful. They go on to raise Series A and Series B and Series C and whatever follow-on rounds. Then they sell for $1 billion down the line somewhere. Amazing. Well, you should expect that you got diluted pretty heavily throughout that whole process. So let's say, for sake of round numbers, that 10% is now worth 5%. And your 5% ownership returns $50 million to the fund. If you are a $200 million fund, that only returns a quarter of your fund. That's not amazing. If you're a $25 million fund, that returns 2x your fund. That's very nice. And so backing into and understanding the ownership you think you need at entry is critical. Like if you can't get ownership in companies, if you have low ownership, you have to be expecting huge, huge, huge outcomes, like generational company outcomes. So if you have $400 million fund and you're getting low single digits or single digits ownership at all, you have to be underwriting that this is going to be like a $10 billion plus company. And there just aren't that many of those to return the fund. And so following off of ownership is, okay, if we want to own 10% of all of our companies at entry, we want to work backwards from that ownership and understand, if we think the typical seed deal has this price, what's our first check usually going to look like in order to get that ownership level? And so the example I have here is, let's say it's a Canadian seed company raising at a $10 million pre-money valuation, raising $3 million. That means the company's post-money valuation is $13 million. If a fund wants to own 10% of that business with their first check, they need to write a $1.3 million check into that business. And so that gives you a sense of like, okay, what does my first check broadly need to be? And then from there, you can map out a follow-on strategy. And there are tons of different perspectives, tons of very valid strategies funds can deploy to maximize ownership and manage all these dynamics. One such strategy is to double down on your winners, where you seek to not just protect your ownership, but increase your ownership in those positions. That's something that a big fund could really do successfully. If you are a $200 million fund and you get 10% ownership in a company for a $1.5 million check, you could lead their Series A with a $200 million fund and write a $7 million check in their Series A and plausibly increase your owner position substantially. That's much harder for a 25 or $30 million fund to do. You just don't have the capital to follow on that way. So for those earlier stage funds, and that's where I fall, my mentality is the ownership you buy at seed is always going to be much larger than what your follow-on money is gonna get you. Whereas bigger funds can play a different strategy. There are some funds who have a zero follow-on strategy. They want to get lots of portfolio companies at a certain set ownership and just let them ride. And I'll get into the logic for that a bit later. So connecting to this is ideal number of portfolio companies. So if you know your average first check to get your ownership, and you know I want to have enough volume of companies in my portfolio so that I have enough shots on goal to increase the odds that there's a big outlier in my portfolio. Venture is a power law business. A small portion of your investments will generate 95% of the returns. You need to have outliers. And so you want to look at how many portfolio companies do I need to have to position myself so that I have high odds of hitting an outlier. And so one thing you have to look at there is a survival rate. So this grid I have on the table here, on the slide here, assumes a 70% survival rate. and it's showing if you have between 10 and 30 investments that you make at the seed stage, if you assume a 70% survival rate from round to round to round, so C to A to B, B to C, C to exit, this is very arbitrary. You can see what your later stage pool of investments, those are plausibly the ones that are going to return capital to you, how big those are. So in this example, a 20 portfolio company uh, uh, fund, you'd expect to have like 4 companies or 5 companies at that late stage, which is, I think, generous. And so that gives you the sense of why shots on goal matter. You need a certain number of deals in the portfolio to increase this. And then pacing is just this idea of like, if you want 30 companies in the portfolio and you have 3 years to build that portfolio, you need to do 10 investments a year. And so just make sure as a fund you're tracking towards that. And so this is really, if you take anything away from this whole conversation, I would say it's this. And so what funds have to manage is this Goldilocks dilemma in their construction. You either have not enough portfolio companies or too many. And having not enough, that could happen if you're like over reserved. So you've reserved lots of capital to follow on into your companies, or you just, wrote a lot of big checks into a small portfolio. You risk being too concentrated. And so you have a lower likelihood of finding an outlier. Basically, you're saying, I'm going to be an amazing selector because I have 10 portfolio companies when people say I should have 30. And that can generate in lower returns if none of those companies hit. The benefit of this strategy is you can make money on a lower exit value. The other side of the coin is having too many portfolio companies where you don't own very much of any of them. And so if any of them hit, they don't really do anything for you. And so this is like funds that will have spray and prayed or like squeezed into hot deals by just like getting checks into those like hot consensus investments. That certainly happen. And so if you have, 1%, 2%, 4% ownership in a bunch of these companies, you could have a company that has a really great outcome, but it doesn't really move the needle for you as a fund because you didn't own enough of that company at exit. And so the TLDR here and the main takeaway is you need to have enough shots on goal, enough portfolio companies to increase the likelihood of having a breakout or multiple breakout portfolio companies, but ensuring you own enough of those companies so that they can be really lucrative to you if they do break out. This is really hard. This is more of an art than a science. No one's going to be perfect at it. You're dealing with like forecasting the future, tons of risk, really hard to do. But thinking about it and having a methodology and being discerning and disciplined at least positions you for success. I have a personal bias that I'd rather be more concentrated than too spread out because I think what I said about the future of startup markets, I think if the terminal value of companies is lower, you just have to own more, you have to have higher ownership in businesses to return. And that kind of trends you to being more on the concentrated side of the spectrum versus the shots on goal side of the spectrum. Other people have totally different opinions than I do on that, and that's great. But this is an important concept. I'll pause here. Any questions on anything? I'm basically done. Recycling is next. So any questions on this?
I have a question, but I'll let anyone else jump in if there is. So well, I feel like it's kind of a two-part question. First question is how many portfolio companies is StandUP invested in? Or like what's the average number that you kind of like to be invested in?
So yeah, it depends. So if I'll speak to our second fund, which is a $35 million fund, we're looking at between 20 and 25. And so, but we are attempting to have, and so far have successfully had what I would consider like uniquely high ownership for a fund our size in these companies. And I don't want to share like too much, but like there's the rationale for that is like if we look at our thesis, our TAM for the deals we can do in Canada and in the US, I also have a thesis that like the best companies of the next 10 years will raise less capital than the best ones of the previous 10 years, and we won't be as diluted by follow-on investors. The idea there is that, you know, we, with 20 to 25, we have enough shots on goal, and we also can return our fund with a sub-billion-dollar outcome, which I think to have like a real like 4 or 5x fund, you do really need an outcome like that still. But you can have a pretty good fund by having a multi-hundred-million-dollar outcome and owning a really good chunk of that company, which happens by securing that ownership at seed, judiciously following on only in the companies that you're really high on, and backing founders that want to build efficient businesses and won't need to raise as much dilutive follow-on capital. Yeah.
Cool. And kind of an add-on question to that, what does the, like, obviously it differs from company to company and fund to fund, but what does the relationship between the fund and the company typically look like? Like, how much communication is there? Is it like,
Yeah.
what does that kind of look like?
Every fund is different. And that's also a consideration operationally when you set up your number of portfolio companies. Like if your strategy is to do high volume, like you just physically cannot have deep relationships with the companies. We are a high conviction investor. We're more often than not the lead investor. And so we work really closely with our portfolio companies. That formally looks like a board seat or observer seats. So we have like actually playing a role in the governance of the company. From a more like kind of working relationship cadence perspective, in addition to the board, we certainly have like a monthly touch point where we know to look at like certain metrics and are talking about certain things. We often have like joint Slack channels with them, and so are on like pretty regular contact. Like some founders I talk to every day. And then we have a two kind of other ways we support, which one is like just tactical stuff. We really focus on go-to-market and strategic finance. So we're like really focused with companies trying to proactively, even within diligence, identify what we want to work on with them on go-to-market and strategic finance before the investment's even made, and then work towards that with them post-investment. And the second piece that I think is really unique about StandUP is we've built a really interesting community where the founders themselves are working really closely with each other. And so what's unique about StandUP is there's at least one woman founder on every team. And we've done a bunch to animate that community and make it feel like a supportive ecosystem that folks can lean on for help. And we've seen some really, really interesting kind of organic things bubble up out of that as well.
Cool. Thanks.
Any other questions, or should I move to recycling? Recycling it is. Okay, so concept here is I mentioned earlier that you that venture funds charge fees to the investors to run their business. Like to use round numbers, are usually around 2% a year. So if you have $100 million fund, you're charging $2 million in fees a year. What that means is you're actually only investing $80 million of that $100 million fund, because 2 times 10 is 20. You're taking 20 million of that 100 million to run your business. These are round numbers. It doesn't work exactly like that, but for the sake of this, it's totally reasonable. The idea of recycling is taking early exits you have in your portfolio and putting them back and investing them again. And the idea is you want to get back to the full 100% or more of your funds. You want to, if you're a $100 million fund, you want to try and put $100 million or more to work. And The logic for doing this is it can be really accretive. You can generate more cash on cash returns by doing this for your LPs, and it just lets you further optimize for the power law. So there are two places you could recycle capital. One is into net new portfolio companies. The other is to follow on in portfolio companies that are really breaking out. So, two examples of how this could work out. Let's say in your first year of your fund, you invested $1 million in a seed stage company, and a year later, it sells as an early exit, which is like not what you anticipated, but it could be profitable. Let's say you 2x your money and you made $2 million. You can take that $2 million and put it into a new portfolio company. You just recycle that money. This one wasn't the power law outcome. Let's put it back onto the board to try and create another power law outcome. The other thing you can do is you could have a portfolio company that sells in the 5th year of the fund when you're not doing new portfolio company investments, and you make, I don't know, let's say make $8 million off of that. You could put some of that money or all that money into the 2 or 3 best companies in your portfolio that are really performing. You could, just lets you write a bigger check in a follow-on scenario, and really double down on your winners, so to speak. And what this looks like mathematically is visualized in this chart. So this is a $100 million fund, and it's 3x'd itself. And so the number you're seeing here is at 80%. This is net of fees. You'd be returning at 80% of the capital invested. So $80 million invested, $212 million are returned to LPs. This is after fees and carry. I haven't talked about carry, but basically don't worry about it for this example. If you invest 90% and you generate a 3x return on that incremental 10% of capital, you can generate an additional $16 million of returns for your LPs. If you generate a 5x return on that additional 10% of invested capital, you can generate an additional, what is that, $32 million of capital, of returns for your LPs. And you can see in the most extreme example where you've invested more than your fund and you 5x that incremental capital, you've basically added another $100 million of returns here. So sophisticated LPs, they want you to put the full amount of money to work, because they're in the let's generate returns business, not necessarily the downside protection business. And so you can do this in a pretty accretive way if you're judicious. And it's actually quite hard to achieve a top quartile or top decile returning fund without recycling. So it's a really important, like, kind of in the weeds concept that successful fund managers have figured out ways to do. It's hard. You have to have exits, or you have to have the conviction to, invest your fees in companies and run your business with, taking no salary or whatever. Yeah, I see some laughs. I don't know if that's something else or this, but yeah, that's all I got for you today. So any questions about this or anything else, happy to answer them. But really, really nice chatting with everybody today. Hey, Liz and Alex.
Hi, Lucas. Thank you for the presentation. Just one quick question from us. Can you elaborate on what does like 110% mean in the?
Yes. So yeah, I'll use it in the actual terms here. So it's a $100 million fund. 80% implies you're investing $80 million of that 100 million. 110% implies you're actually investing 110 because you've recycled exits beyond, you're literally investing profits back into the business. So keep in mind, the $100 million fund, 20 million of that is extracted in fees. It's not being invested. So the default position is you're investing 80 million. So by recycling early exits that you get and generating liquidity in those companies so that you can recycle them, the more you can invest, the more you position yourself to return more capital to your LPs. So this concept here is, I could probably reorient this table so it's easier to read, but 80 million invested, 90 million invested, 100 million invested, 110 million invested. And then this part is what's the multiple you generate on that incremental capital. There's obviously a zero option here, which reduces things, but that's not the game that we're playing.
Yeah, I think you explained it very well. So it's like the extra 10 million profit you generated, and then you recycle it back to invest in the existing. Thank you.
So like the most round number example is, I think your $100 million fund, you recycled $10 million. That got you to $90 million deployed. And let's say on that 90 million, you 5x that, sorry, on that additional 10 million incremental that you put in, you 5x'd it, you made $50 million. That's a lot of money. Obviously, that'd be a really great outcome. But that's a lot of money that changes the whole kind of complexion of your fund's performance. But even if you generate 2x on it, it still changed the complexion of your DPI pretty meaningfully.
That makes sense. Thank you.
Any other questions?
I have one question to end us off, Sylvia. I just saw you come off mute.
I'm sorry, go ahead, Megan.
No, go ahead. My question is to like wrap us up. So feel free to throw in any questions before.
Okay. So no, I was just wondering because I've heard about like VC continuation fund lately, but I'm not sure because StandUP Ventures is more like on the smaller like seed stage.
Yeah.
If you would share your view on it, or I don't know.
Yeah,
Maybe.
so I'll be honest, I don't know that much about it. I actually, to be completely transparent, Ian at Northleaf actually had a session for us to like expose us to more of this stuff like recently. So but what Sylvia's asking here is there are a bunch of like other tactics that fund managers can take to generate liquidity. And and a continuation fund is one of those concepts. You can even do things like selling secondaries, which is like the company. So let's say you own shares in a company that's doing well, and you know it's just time for you to exit that position. Your LPs want capital back, or you just think it's the right time to exit it. You can sell your share to somebody else, and that company doesn't have to have like a liquidity event and be acquired to go public. Like you can facilitate that. That's the most like simple way to do this, and you can use that capital. So Sylvia, your colleagues would be able to provide much more insight on that than I can.
No, I actually can't. I am under Ian, but he doesn't give that presentation to me. He presented to
You can ask him. Ask him.
Okay. Actually, I have one more question about the sourcing. So I would like to know how you maintain your network. I've heard things like, Koru, for example. So it's kind of like a venture building. So design like a Sagart's design studio, I think, if I'm not mistaken.
Studio.
Yeah, I think so. There's a bunch of private equity investing, and instead of incubator, it's more like a building ventures, if I'm not mistaken.
Yeah. So that venture studio is like a distinct approach. I think it's very interesting. It's just not what we do. What a venture studio is doing is they're basically like creating businesses, finding founders to run those business and like trialing those ideas and then funding the ones that really break out. What I like about that model from a math standpoint is the venture studio as a fund can own like 40 or 50% of the company. And so from our ownership conversation, that's super meaningful. I think there's other concerns I have with that around like, I personally think founders should be like compelled to start their businesses and like really should be like an obsession. And I'm not sure like the studio path, people who are good at it are good at it. In terms of sourcing, every venture fund has a different strategy. For us, we're always sourcing. So, all of us are constantly like keeping tabs with other investors, accelerators, tracking people on LinkedIn. We're tracking companies that we met super early to see how they progress, and maybe we can invest when they reach a certain inflection point. All of us are, present in communities. We're speaking at events. We're sponsoring things. Eventually you just build kind of like a network where you get a lot of inbound as well as doing this outbound work. And everyone's strategy will be different and will reflect the kind of type of companies they're going after and what those companies, where they spend their time, basically.
Awesome. Thank you for your answer.
Cool. I know we only have about a minute left. Are there any other last minute questions? Cool. Okay. So my final question to you, Lucas, is what is your why? So why do you wake up every morning to do what you do? Why does it energize you? Why do you do what you do?
Great question. I should probably have a more succinct answer. But one thing I've been thinking about more lately is being a VC is a really great way to be an optimist. And if you have an optimistic view of the future, which I do, you get the opportunity to, in a small way, in your own corner of the world, like back the future. And I find that super exciting. In a kind of world where doomerism is unfortunately prevalent, I really get a lot of energy from that idea and from spending time with extremely ambitious, bright-eyed people who want to make a dent in the universe. So I guess that's my pithy
Love it.
answer right now.
Sweet. That's a perfect way to end us off. This was awesome. Thank you so much. I honestly was like very much listening that whole time because I am also new to the VC industry, that this was very helpful for me. And I will definitely be reviewing those slides later. But like I said at the beginning, we'll send those slides out to you guys just so you have them. And then if any other questions do come up after the fact, let me know and I can pass them along to Lucas. Otherwise, our next lunch and learn with Kathy from Instar, who's going to speak to the private equity side, is on August 15th from 12 to 1. You should have all received a calendar invite for that so far. And if you haven't, let me know. But otherwise, we will be also in touch about the fund manager workshop that we're going to be doing for you guys. So stay tuned for that. But otherwise, I hope you have a great rest of your week, and we'll see you next time.
Thanks, everyone. Great to meet you all.
Thanks so much, Lucas.
Thank you, Megan.
Bye, everybody.
Thank you. Bye.
Thanks.